A very, very warm welcome to you all. Thank you for joining us. And for those who are watching it back on recording, welcome. Today, the lovely Emma Bale will be taking us through how the key changes in the autumn budget will impact us small business owners. So the budget, just to set the scene, the budget is really complicated. And although we're going to try really hard to make it as easy to understand as possible, there is still a lot of debate around the different elements. So as it's only 5 days post budget, and even within Emma's really big network of um, fellow qualified accountants, everybody is still trying to get their head around it. So if you're feeling a bit overwhelmed, don't worry, you're not alone. Even some of the most incredibly experienced accountants like Emma are still struggling to work out what it all means. So as part of Evolve Accounting's mission, vision, and values, you may or may not recognise, but the focus is to make tax and accounting really easy for everybody to understand, even people like myself. It's a family-run business, and Emma and Simon appreciate that finances can be really confusing. My eyes are over here because we've got some more people joining as we speak, so I'm multitasking everybody. So we appreciate that finances can be really daunting. They're obviously very important, and we want this to be a really safe space for everybody today that you can ask some questions and share any worries or concerns that you may have. So as we go through this session, I'll be keeping everybody on mute, but please do drop the questions in the chat. I will try to pick an appropriate time to ask those questions with my limited accounting knowledge. So apologies if it's a little bit sporadic how I ask the questions. However, if we don't get to answer all the questions during the conversation, we will have some time at the end to pose those to Emma. And I can either do that or you guys can ask her yourselves. So we're going to try and keep the session as informal as possible. We're going to be using slides to help different learning styles. So please feel free to use your settings within Zoom to either minimize the slides or minimize us talking, however you prefer to learn. We appreciate that we want to include everybody in with the different learning styles in this session. So if you have any questions about the settings, my name's Lynette. As you can see, you can drop me a direct message on Zoom and I can try and help you navigate that. Emma. Thank you so much for taking us through this today on behalf of everybody here. Please go for it. Tell us all about it.
So thank you, Lynette. If I've never spoken to any of you about Lynette. Lynette is literally my wing woman, and that's the name of her lovely business. And Lynette helps me with all things marketing, including setting up this lovely webinar, which I would not technically know how to do. So thank you so much, Lynette.
Pleasure.
And when I start pressing the wrong buttons or doing something wrong, Lynette's going to swoop in and rescue me from
I've got you.
from myself. Okay, so I'm going to start today. I can see so many lovely familiar faces of clients that have been with me for quite a few years now, and it's so lovely to see because that's eased my nerves a little bit because this is the first time I've done something like this, and I hope to do more. But I can see there are some names on here that I don't know, who either are not yet clients or are very new to us, and we haven't started working together. So I'm just going to quickly run over who I am and what I'm about, just so that everybody knows you know who you're talking to. So my name is Emma Bale. I am a qualified accountant, and I am qualified with the Chartered Institute of Management Accountants, so that's known as CIMA. And I've been qualified for a really long time, but I've been working as an accountant for 25 years. I think I've been qualified about 20 years. And I have experience across a variety of industries. I worked for a long time in London with very large multi-million pound organisations. I also grew up in family business, and my business now is about taking all that knowledge from big business and supporting small businesses. I'm married to Simon, who is the co-founder of Evolve Accounting. We've got 4 children. 3 of them live at home. One of them's out in the world. We live near St Neots in Cambridgeshire. And I, along with Simon, is the co-founder of Evolve Accounting. So we're a husband and wife team. We've been going 10 years. Actually, October was our 10th birthday. So we started the business in October 2014. So we had some lovely celebrations around that. And it's really nice now. I've got a couple of clients on this Zoom who've been with us since fairly close to the beginning, and some that have joined along the way. We specialise in supporting small limited companies, sole traders, partnerships, and rental property owners. So we're very much in that small business owner. So there won't be anybody on this Zoom who are big businesses. So you will all have, you know, whether you're a sole trader or a limited company, you're all going to be having similar challenges and similar worries. And that's who we're very much in business to support. We do all the standard stuff that accountants do, so year-end accounts, tax returns, bookkeeping, payroll, VAT returns, all of that. But we try and do it in a more tailored approach. And I think, you know, that there's a few of you there that I've been working with for a while will know that, you know, I try and work out what you need, and then we work that out. And that can, although you all need accounts doing, you all need your tax doing, but everybody needs, and Lynette talked a little bit about different learning styles. So we do try and work with you in terms of what you do. And that's really the ethos of our business. Is to work with everybody on a very tailored one-to-one basis. That's my little introduction. I'm going to move over to the slides now because I like a slide, and that's going to help me to not go off on a massive tangent, and it's also going to give you a little bit of a visual prompt. But as Lynette said, if that doesn't work for you, you can click away from the slides or do what works for you.
And if anyone needs any help to work out how to move the slides around on their screen, just shout in the chat and I'll help offline.
Brilliant. Right, I'm going to try and share without accidentally disconnecting myself or cancelling the entire.
If you do, you can come back in. It's cool.
Oh, I've done it. Look, straight away. Can everybody see the slides?
We're winning. We're winning.
Oh, look at that. There we go. First hurdle over. Right. Okay. So the budget. Okay. So the government releases a budget every autumn, and it sets out the government's financial plans. And those plans cover personal tax, business tax, spending plans. And this one's been really quite significant for a couple of reasons. The first is that it's the first Labour budget in 14 years. We've had 14 years of Conservative government. Labour's come in. So everybody was expecting, wherever you sit politically on, you know, which side of the fence you sit, I think everybody was aware that this was going to be a very different budget. It was going to be a more Labour budget than it was going to be a Conservative budget. And also a lot's happened in our country over the last few years. We've had COVID, we've had Brexit, cost of living, which has squeezed, I would say, almost every business in one way or another. So this budget has felt kind of a bit more massive than maybe some of the ones before, and recent ones have been quite big as well. So I'm going to cover today the key issues that impact our clients. I'm not going to cover everything because I couldn't possibly do that in the time we have allocated, and actually not all of it relates to all of you. And I don't think it's going to help a small business owner for me to talk through my views on NHS spending, for example. So I'm really going to focus on what I think our clients and you guys and the people that we work with is going to be most useful. But you can, if you fancy a little bit of light reading, you can read the budget in its entirety. And I've put the link on the bottom there. I can send this out if you want to see it. But if you literally Google, Autumn Budget 24, put .gov, and it will take you to the government website, and you can have a plough through the whole document, which I have done. It's not an easy read, but it's there, and it is interesting to go through. Okay, so what I'm going to do is I'm going to cover off like the easy bits first, the things that I can talk through really quickly, where there isn't really that many changes, and I think we'll get to the sort of more complicated bits in a bit. And I think what most of you, I would imagine, what a lot of you are particularly going to be wanting to know is about employers' national insurance and how that's going to affect you. So I'm going to get to that bit, but I'm going to try and cover up the easy bits first, because once we get into employers' national insurance, I think we'll be talking quite a lot. So first of all, limited companies. So I think probably about half of you run a limited company, a small limited company. And I know I've had emails over the last few weeks asking what my view is of what will change, people worrying, will corporation tax change, will dividends change, all of those sorts of things. So this one first is a bit of a reassurance slide, which is corporation tax for limited companies. So if you're a sole trader, you don't pay corporation tax. But corporation tax increased in April 2023 from a flat rate of 19%, and they put that up to 25% with a marginal relief for small profits. So if your profit is over 50,000, it starts to increase the rate of corporation tax. You might pay 20%, 22%, whatever, up to a total of 25%. They put those increases in last April. So we've had 18 months to get used to that. We're all, I think, I've done a few of your tax returns already with the new rates of corporation tax. And so you're seeing those come through. They're staying the same. They're not touching them. They're not increasing them. They're not putting them down either, but they're staying the same. So I think we know we've got a good, a few years ahead of us now with some real stability with our corporation tax. And it remains capped at 25%. So that's the most you're ever going to pay. And that's only if your profits are up to £250,000 a year. The annual investment allowance remains the same at £1 million. So that is when you buy some, equipment, computers, things like that. That's the amount of, so that you can put the entirety of the cost of that new computer or that new piece of equipment through at 100% annual investment. And that stays the same. So we'll continue to do that for you. And dividend rates are not increasing either. And I know, like, I've had at least 3 emails in the last couple of weeks. Are they going to should I take extra dividends out of my business before they put the dividend rate tax rates up? And they haven't done it. So that remains at 8.75% for basic, 33.75% for higher, and 39.35% for the extra rate. So for the top rate. So that remains nice and stable. And we've had those in place for a couple of years now. The only thing that's really, really going to affect you as a limited company in terms of tax is the national insurance on your director salary. And if you have any employees, so it's the employer's national insurance. We're going to come to that. I've got a whole slide for it. But everything else is unaffected, which is good news. Sole traders, same message. No increase to income tax. No increase to the rate of national insurance you pay. Your personal allowance will remain at 12,570 until April 2028, when it will start to increase. So I suppose that's the only way that that's really going to affect you, is that I'm assuming that you're reviewing your prices every year, increasing your prices with inflation. And if you're not, then have a chat and we can talk you through how to do that. But it means that your profit will be increasing every year as you grow your profit, but also as you're increasing your prices. But because they haven't raised the personal allowance, so that £12,570, which is what you can earn tax-free before you start paying tax, more of your earnings are going to be sucked up into the tax-paying bracket. So although they haven't increased income tax and they haven't increased your national insurance, more of your earnings will become taxable as you earn more money, as your prices increase with inflation. And that's something, again, we can help you with in a bit more detail on an individual basis. I'm going to go through these quite quickly. So business rates from April 25, and this is just for retail, hospitality and leisure. They're lowering the business rates, and the bigger year is 40% relief on business rates for retail, hospitality and leisure. That's starting from next year. There's obviously a really big push to help this industry, and I've got a couple of clients in this industry, and it has been really difficult since COVID, hasn't it? And so there's that bit of support there. There's also the penny off the pint, isn't it? So I think they're trying to encourage people more back into retail and leisure and hospitality. Business asset disposal relief, which won't really apply to anybody. So I'm kind of on the fence whether to do a slide on it or not, but stuck it in. From April 25, the £1 million relief is to be maintained and the rate is increased to 14%. That's only if you're selling a business, and I'm pretty sure the people on here are very much holding on to their business for now. But if that's something you want to have a more detailed conversation about, I'm here. All right, okay, so I'm just gonna have a little sip of water.
It's all good. I just came off mute and said, it's time, it's good, it's good.
Rental properties and capital gains. So this is the one that I think, has been anticipated. It hasn't come as a surprise to anybody, really. I think everyone knew this was going to happen. So they have put capital gains, the rate up, and they've lowered the allowance. And that's for the immediate effect. So that the budget was announced on the 30th of October, and the capital gains increase is from the 30th of October, which I don't think everyone was quite expecting that. So the lower rate of capital gains tax that you will pay is increasing from 10% to 18%. So the higher rate is increasing from 18% to 24%. The allowance, so the amount of capital gains tax that you can earn before you start paying capital gains tax, remains at £3,000. So to put that in layman's terms, you have a rental property and you've got tenants in there, you decide to sell that rental property. The profit that you make, so effectively how much you sell that house for, less how much you purchased it for, less a few costs that we can sling in there. So the profit, less that £3,000 allowance that you're allowed to have, that profit is what you're going to pay your capital gains tax on. And it's also worth remembering as well, if you sell a property, and this has been in place for a little while, but it's always worth mentioning and reminding, you do have to submit that capital gains, make that submission to HMRC within 60 days of completing sale. So that's, that stamp duty. That again is with an immediate effect from the 31st of October. So that came into effect the day after the budget was announced. That's increased from 3 to 5% on additional dwellings. So this isn't your house. So, if this is your house that you live in and you sell it and you move, this doesn't apply to you. This is if you own a second home, a buy-to-let residence, which I think is mainly our clients are those that sort of have these little buy-to-let properties. And if you're a limited company purchasing residential properties and running that as a business. So that is where the stamp duty has increased from 3 to 5% with immediate effect. So anything that you do from now on, you're going to be paying that. So this does get, and we have probably, once a month, in fact, I've got an email in my inbox actually with somebody who wants to sell a property and capital gains tax. It can get a little bit involved. There are some online checks that you can do using the government website to get a bit of an idea on capital gains tax. So they're always worth using. And then when you actually get to needing to do more realistic calculations, then we're here to support. But those are the major changes there. Okay, so employers. This is the biggie, I think. And I think this is the one for most of you. You've probably been sitting there sort of drumming your fingers on the desk waiting for me to talk about this, because this is the thing that's going to affect most people. I'll do the easy one first. So the national living wage. So from April 25, the hourly rate the minimum hourly rate that you legally have to pay someone is going from £11.44 to £12.21. 18 to 20-year-olds, it's going from £8.60 to £10 now. So it's really important between now and April to review all of your staff and make sure that those changes are put in place in time for April. There are penalties. It will get a bit serious if you don't do that. How that will affect your employees, starting with, is that we talked about the personal allowance hasn't been increased, the 12,570. So these people on the lower end of the wage scale, more because they'll be getting this increase, but the personal allowance isn't being increased. So they call this is the drag. More people are going to get dragged into paying tax on a higher percentage of the wages. So that's something to be aware of for those people on the national living wage. And it also, this increase could possibly affect the employer's national insurance that you're going to be paying, which is what I'm going to move on to next.
Sorry, Emma, could you just explain that first bit that you just said again, the bit about the living wage going up, but the allowance isn't?
Sure. So everybody is entitled to, or almost everybody is entitled to the £12,570 personal allowance tax-free. So not everybody, but most people, you can earn up to that amount and you're not going to pay income tax. You then pay income tax for any amount that you earn over the £12,570. So if your rate of pay increases, you're earning more money. But what the government used to do is increase the personal allowance every year so you can earn to allow for inflation. So every year you should be able to earn a bit more tax-free, and that allows for inflation. What's actually happening at the moment is it's a little bit of a sneaky way of increasing taxes without increasing taxes. So it means that your personal allowances your amount of money that you're being paid is going up, but your personal allowance is staying the same. So more of your money is being dragged into a tax-paying position. Does that make sense?
It does.
It is really difficult to get your head around, but it's to do with inflation because, people are receiving pay rises, hopefully most years, to reflect, especially recently with the cost of living. I mean, if you think about nurses or doctors, for example, they've done the doctor's pay, or the train drivers is another one. So they've negotiated these increased wages reflecting that inflation has been quite high recently, and therefore in order for people to maintain the same standard of living, their wages need to increase. But if the personal allowance isn't increasing with inflation as well, if they're not also putting the amount of tax-free money you can earn, you're sort of indirectly ending up paying extra tax on that anyway, because that isn't being reflected in the personal allowance. They will start putting that up from April 28, but it's a sort of slightly sneaky backdoor way of increasing taxes without increasing taxes.
Thank you, Emma.
Thank you. Employees' national insurance. So this is the big one. This is the one that's just bamboozling everybody, and it's the one that I'm getting all the emails about. So from April 25, employers' national insurance will be increasing from 13.8% to 15%. So that's a 1.2% increase. So let's just quickly talk about what employers' national insurance is, so we're really clear about what we're talking about. Employers' national insurance is if you employ somebody, you've got somebody on the payroll that once a month, possibly I'm doing it for you, once a month, we are producing a wage slip, you are paying your employees, I'm making the submission to HMRC on a monthly basis and telling you how much tax you need to hand over to HMRC, including in that will be employers' national insurance. So at the moment, for each employee, if you are paying your employee more than £9,100 a year, the bit of their wages that is over 9,100, you then have to pay the government 13.8% employers' national insurance. Okay, they are now increasing that from 13.8 to 15%. So you're going to pay a higher rate of employers' national insurance. They've made a couple of other changes as well, and it's three moving parts, so it gets a bit complicated. They're also reducing the threshold. So at the moment, for each employee, you pay employers' national insurance of the bit of the salary that is over 9,100. They've now lowered that down to 5,000. So if you pay your employee £20,000 a year, you will pay national insurance, employers' national insurance on £15,000 of that £20,000. But instead of paying 13.8%, you will now pay 15%. So you're going to be paying a higher percentage on a bigger proportion of the salary, which is quite scary. But there's a third moving part to all of this. If I've not lost everybody already, because I know it's quite a lot. We have something called the employment allowance. So the employment allowance this is set up for small employers. So at the moment, it's set at 10.5, so it's set at £5,000, I should say. So let's say you've got 3 or 4 employees and your total employer's national insurance bill comes to £4,500 for the year. You don't have to pay that because you have an allowance of up to £5,000 that says you don't have to pay that first £5,000. So we calculate, and if I do your payroll for you, you'll see it on the reports that I calculate for you. This is the employer's national insurance you have to pay, but because it's under the £5,000, you get this allowance. If, say, your total employer's national insurance bill is £6,000 a year, the £5,000 you're getting as an allowance, so you only pay the £1,000. Does that make sense so far, Lynette? You're my check. Am I good so far?
So yes. However, I'm still getting my head around this, the employment allowance. So the allowance is the amount of money that you don't have to pay or do have to pay.
So it's the amount of money you don't have to pay. So if your total employer's national insurance bill comes to £4,500, because the allowance currently is £5,000, you don't have to pay that £4,000. So effectively, you can incur up to £5,000 of employer's national insurance, and you don't have to pay it.
So is this only
this is how it currently is.
So this is the national insurance for. So this is for all size businesses?
Yeah. So this is if you have employees on the payroll. This is your employees, however many you have, 2 or more, I should say, at this point. You have an allowance of currently have an allowance of up to £5,000. So you can incur up to £5,000 of employers' national insurance, and the allowance will wipe that out. You don't have to pay it. Anything over the £5,000, so if your national insurance employer's national insurance bill comes to £6,000 or £7,000, the £5,000 you don't have to pay, you get the allowance against it. So then you just have to pay anything over the 5,000, so £1,000 or £2,000.
Natalie just said, is that per year, not per month?
Well, we do the monthly payroll. It's an annual allowance, but it's sort of
Okay,
divided
annual
by
allowance.
12. Yeah, good point. That's a really good point, actually. Yeah, but that's how it works. So they are putting that allowance up to 10,500. So that means that although your rate of national insurance you're paying is increasing up to 15%, and the threshold, so the point at which you become eligible for paying national insurance, is coming down to 5,000, the amount of employment allowance that you can have and to credit against it, if you like, before you actually have to start, is increasing. It is more than doubling to 10.5 grand. Now, they couldn't have made it more confusing, could they? Because they've literally, it's 3 moving parts here. And you read that, and I sat on Thursday with my notepad and pen, and she explained it, and I went, pardon? And I paused it, and I rewound it and read it again. And and then I had to come into my office with my spreadsheet and kind of try and work out, well, what does that mean? What does that mean for anybody? I didn't even really know what that meant for my business. So what I'm going to try and do is give you kind of examples of how this is going to be different for everybody, right? But sort of the 3 main groups of people who I think are probably on this webinar today. And I'm going to try and talk through how this is going to affect you. And then I'm going to talk about what I can help you with. I've got a little spreadsheet that I'll be able to sort of, we can work through. So the first one I'm going to cover is the group of people who are a single director of a limited company. So there are some people who choose to run their business as a limited company and put themselves on the payroll, and they pay themselves a combination of small director's salary and dividends, because I've advised you that's the most tax efficient way to do it, which it is. Unfortunately, the employment allowance that we've just talked about, so the 5,000, which is going to go up to 10,000, you're not entitled to claim that, because you're only allowed to claim that if you have 2 or more employees. So if you are a single owner director of a limited company, paying yourself a director salary of £12,570, which that's the most efficient way to do it, you are already paying £478 worth of employer's national insurance per year. And that's fine. That's the most tax efficient way to do things. And you're already paying that. When you get the monthly pay reports from me, it's about 39 quid a month that you're paying to HMRC. That's going to go up because you're not entitled to the employment allowance. The threshold reducing doesn't really help you. And you are subject to the tax rise. So you're going to get stung by an extra £657 a year. That is going to go up to £1,135. So there's been a lot of debate within the accountancy community of, do we change our advice to that group of clients? Do we tell them to take a different level of salary out? I mean, I've sat there with my calculator and worked it back into. My advice at the moment is stick. I mean, this doesn't happen till April anyway. This isn't immediate effect. This happens in April next year. My advice at the moment is to stick with the 12,570. Yes, you are going to be paying more national insurance, employers' national insurance. There isn't a way around it, but it's at a rate of 15%, which is still less than tax at 19%. So it's still worth you doing. It's just that, and you'll have all felt this over the last few years, corporation tax has gone up, dividends have gone up, the dividend allowance went down a little while ago, and now they've put this on it. So the tax efficiency of being a limited company is becoming eroded. It used to be that being a limited company was wildly more tax efficient than being a sole trader. That gap's really closing down. There's still lots of benefits to it. There's still some tax advantage, but this is another kind of, where they've taken that tax benefit away from your single sole directors. So, and I would say for my, as part of my payroll offering, you all know I work with every single one of you at the financial year end, and we talk about what is the best director salary for you, and you'll get that same advice in April. And the devil's in the detail. More advice and more information might come out in the coming days and weeks, but I think it is what it is. Like, we are just going to be paying more national insurance on that. Okay, so that's single owner directors. The next group of people is people like me and Simon. So quite often husband and wife team, two family members, two friends who have set up a limited company. They're both owner directors. So they're both paying themselves a low director salary and then the rest in dividends. So you're not really going to be affected by this. You guys do not pay employers' national insurance at the moment anyway, because you are entitled to the employment allowance, and that will continue. So you're not really affected by this. There is some discussion and there's some argument, and it depends how you run the numbers, and it depends on what sort of company you have, and all lots of different pensions and different things. There is starting to become, because the tax efficiency on limited companies is starting to be eroded, there is, you know, some argument that actually next year putting director salaries up higher and taking a higher director salary and a lower dividend. It's not really a discussion for this because it isn't really to do with this, but it's an indication that the way we think about limited companies and the tax efficiency around it is changing. But the very quick advice at this point is, if you are two directors, owner director, taking a combination of low director salary and dividends, breathe. You're not going to be paying any extra employers' national insurance. So the next group of people, and the final group that I think I need to talk about, unless I've forgotten anybody, is if you, and this is if you're a sole trader or a limited company, and you have 2 employees or more. So, and that's where it all gets a little bit more complicated, because you might have 4, 5, 10 employees, and now you're thinking, okay, right, so the threshold's gone down, the rate's gone up, the employment allowance is increasing. What is that going to look like? So I have lovingly prepared a spreadsheet. Those you know me, you know I love a spreadsheet. So it's a little bit on the basic side because I've just sort of knocked it together since Thursday. So I've not branded it. I've not done anything clever with it. I'm going to share it with you at the moment, but don't judge me for it because it's very, very basic. But what it's going to allow you to do is, in fact, I'm going to share it first, and then I'm going to, hold on a minute. Let me find it.
We won't judge you, Emma. I think we're all
don't spreadsheet judge me. You know, I don't like to be. It's how I value myself as a person. It's my spreadsheets. Right, okay. So let me just move everybody out of the way. Okay, so this is my little spreadsheet, and it's imaginatively called "Will I Pay More National Insurance?" So a bit of a caveat here. This is only if your national insurance, employer's national insurance bill last year was less than £100,000, which I think will apply to most of my clients because you're all small businesses. Also, don't use it for sole directors or sole employees. I'm going to try and make the formulas work so you can use it, but at the moment you can't. And I've put some dummy data in so you can see how it works. If this is something you'd like me to email to you, even if in its rough and ready form, then drop me an email after the webinar and I'll happily share this with you and send it over to you and then talk you through if it doesn't make any sense to you. So I'll put some dummy data in here. I've completely randomly selected some employee names here that I've put through. I've got 10 of them. So we've got Rachel, Jeremy, Cozy, Nadeem, Rishi, Sajid, Philip, George, Alistair and Gordon. And I've assigned them some salaries, which I may or may not think is what they earned or what they were worth in the time that they were chancellors. And I've then got a column here, which is currently what this dummy employer is paying for employers' national insurance. So what this formula is saying is that Rachel earns a salary of £45,000 gross, that's before tax. And so the proportion of her salary, which is over the current threshold of 9,100, you are paying 13.8%. Under the new employers NI scheme from April next year, the threshold is down to 5,000. So you'll be paying employers NI on anything above £5,000 rather than 9,100, and you'll be paying 15% instead of 13.8. And so for Rachel, the employer's national insurance that you're paying has jumped up from 4,954 to a whopping £6,000. So that shows you actually how much that NI is jumping. You can also see that it's pulling some people into where employers' NI eligibility that weren't before. So Jeremy here, I put him on a very low salary of £6,000. In the current regime, you don't pay any employers' national insurance. You do now, or you will from April, because the threshold is down to £5,000 rather than the 9,100. So there's a couple of examples. So at the bottom here, I've done a bit of total wage bill is 214 grand gross. Currently the employer's national insurance is 18.5 grand. And under the new regime, the new rules, that's going to go up to nearly 25 grand. That's a massive hike. However, you've got your lovely employment allowance, which we can knock off that total NI bill. So under the current regime, your employment allowance is £5,000. So while your NI bill comes to 18.5 grand, we have an allowance of 5, which means you only actually pay 13,500. So we see how that employment allowance is working. Under the new scheme, although your employer's NI bill is going to go up, it's going to go up to a whopping 24, nearly 25 grand, but you have a much bigger employment allowance to put against it. So when you deduct that 10.5 grand employer's allowance, your cost is now 14,400. And so our change, and I've put it there to make it nice and easy, actually what the increase that you see in all of this is £866 per year more national insurance. As Annette said, yes, that's monthly, and so that's divided by 12, but it works out of an annual cost of 866. So that, what I'm hoping what you can do, if you want me to send this to you, is thinking about your own employees. You can delete these out. You can put your own employees in there. You can, put the salaries that you're paying them in there, and it will calculate it for you and give you an idea at the bottom of how much additional national insurance you're going to have to pay. And I'm hoping that's going to give, rather than just listening to me try and explain it, and I realise it's because it's so many moving parts and it affects different people in different ways, I'm hoping this will give you like a bit of a more solid, like a number, like this is how much more it's going to cost you if you this time next year.
I think that's quite reassuring to see, actually, Emma, as well. And so I know this is all kind of opinion-based stuff, but what kind, so really, who is going to be most hard hit by this, do you think? What kind of size is going to be the hardest and hardest hit?
So it's all proportional, isn't it? So they've done it like this, and I think the employment allowance, increasing this really sends a signal to what they're trying to do. They're trying to make it so that smaller businesses, so if you're a small, here is a really good example. So it's a smaller business with 10 employees, it's less than £1,000 increased costs in the year. I remember that is tax deductible as well. It's a tax deductible business expense. So it's going to be the really big businesses that are going to be seeing these much bigger national insurance monthly bills than the smaller businesses. However, it's proportionate, isn't it? Because if you're a small business, and your margins are tight, and even if you're changing employers' national insurance is 500 quid a year, it's still an extra 500 quid a year. So I suppose it depends where you are. I think single directors. So if you're a sole owner-director of a small limited company, that's an extra 657 quid in employers' national insurance you're going to be paying. And it depends where you are. Like if your profit is already under 50 grand, then proportionally that's going to feel like quite a big hit. And it's going to feel like a big hit on top of, the extra tax that you're paying on dividends that have been introduced in recent years, and on top of the extra corporation tax that has been introduced in recent years. So I don't think you can just look at it as a one thing. It's kind of in addition and on top of, and it depends who you are. So I think single directors, you could, and it depends, like, if you're a single director, but with a very profitable business, you might go, 657 quid a year, like that, that's fine, whatever, I don't care about that. But if you're just getting started, just building your business, it's a pretty small, maybe you're running your limited company side, something else, that 657 quid might feel quite steep to you. So
Emma,
yeah.
Michelle asked a couple of really good questions, actually, and one which I was thinking, so Michelle's a sole trader currently, thinking of going limited. With the new regulations, is it worth getting another director on board to benefit from the tax relief
So I mean, I would never recommend just becoming limited for tax reasons only, because it's such a, it is because it changes. There are lots of reasons why you would want to become a limited company that's not taxed. The second thing is directors don't have to have salaries. It is more just that it is very normal. It's the usual thing for owner directors to be directors and then pay themselves a small salary. I would not advise bringing a director in and paying them a salary just for tax purposes, because directors, the responsibilities and power that a director has on a company is huge. So to bring a director in and pay them a small salary for no other reason than to avoid 657 quid's worth of tax, I think you need to be very careful who you make a director of your business. Having said all of that, these things are, the decision to become limited is quite nuanced and is much more complicated. As an accountant, going back 10 years ago, like it would, once a sole trader reached, a certain level of profit, like it was a really easy advice, just go limited. Like, why wouldn't you? It was that straightforward. Now it's a bigger decision and it's a more nuanced decision, and it's quite individual. So I would definitely say, Michelle, book a meeting and we can chat that through in more detail. But the quick answer is no, I wouldn't recommend taking on a director for no other reason but to save tax.
And so I think you answered the question there that was going to be, if people are watching this thinking, oh, I need to find out more about what my business looks like in the next year or so, presumably it's book a call with you, isn't it? Simple as.
It's book a call. I think, more recently, I certainly found with my job over the last few years, the advice I have to give is more specific with every year. There was a lot of very generalized, I used to be able to give very generalized advice, a few years ago, all accountants did. It was very, once your profit as a sole trader is more than 25 grand, yeah, go limited. Like I say, why wouldn't you? It's not as straightforward these days. There's a lot more factors involved. It's a bigger decision. And, it's just not been as stable the last few years. There's been so many changes in tax. So yes, book a meeting. I still think there's a lot of value in becoming a limited company. I think the structure's brilliant. I don't want to go off piece because this isn't really budget related, but I think becoming a limited company is often the way to go because of the structure it provides you, the limited liability it provides you, the status it provides you. It's just that the tax benefit used to be massive, and that is eroding over time.
Thank you.
I'm really aware, as I've been preparing for this today, it's the employer's national insurance bit. I spoke to Lynette about this morning. Like, this is the bit that really worried me because I know it's kind of like it's all these moving parts and it affects everybody differently. So I want to feel like really sure that have I made any sense? Yeah, Kim's putting her thing.
Oh yeah, we've got yeses. Well done, amazing.
Brilliant. Okay.
Even I understand it, Emma. I can't believe it.
Yay. Right. Okay. Let me go back to my lovely slides. I can't find them now. There we go. Okay. Right. So I wanted to talk about this because this isn't like how much tax you're going to pay, because we've covered most of that now. I really wanted to talk about this because I think this is really important. I think it's a bit of the budget that's really, really been missed, and they didn't really say a lot about it. Like Rachel Reeves hasn't talked about it in a budget announcement. It's only when you start wading through all the budget pages you start to see this, but this is really important. So HMRC have been talking for quite a long time about closing the tax gap, and I find this really interesting. So the tax gap is this massive amount of money that's kind of not being paid in tax, either accidentally or on purpose by people, fraud or incompetence, I suppose, or missing it. And there's a few ways that they're trying to close this up, and it really does affect people. So the first one is, I doubt there's a single person on this webinar, myself included, that hasn't had a really frustrating time with HMRC over the last couple of years. Like, it's just, they actually closed their helplines down over the summer because they were so overwhelmed. So you just weren't allowed to phone them at all. It's so frustrating. It's frustrating. I actually know an accountant who has sold his business and gone to do something else because he doesn't want to deal with HMRC anymore. So the good news is they are recruiting 5,000 more compliance staff and nearly 2,000 more debt management staff. And that's got to be a good thing, right? More people on the phones, more people helping. I think it's going to take time, but I'm doing a little, yay. I don't think it's going to be enough, but it's a lot more. They're looking at closing the tax loopholes. Now, for most of you, that isn't really going to, all of my clients, we run a very tight ship. We're not into loopholes anyway. And these are really complicated, kind of really weird things that bigger businesses do, or, so it won't affect you really. But it's worth knowing that HMRC are looking a lot more closely. Improved IT systems, yay, we need that because IT systems and HMRC are rubbish. The one that really interests me is that raising standards of tax advisors. So a really fun thing is that, did you know people don't have to be a qualified accountant. They don't have to be qualified with a professional body in order to be an accountant. So there are a lot of, I know two names in the town actually, who they call themselves an accountant. They have an accountancy business. They sell their services as accountants. They will do your tax returns. They'll do everything for you, but they're not qualified with a professional body, and that's not illegal to do. They're allowed to do it. And it's fine. And I actually know a couple of qualified by experience, not qualified accountants, and they're very good because they've learned by experience. The problem is you don't have the protections. So they don't, like I have my accountancy body supervising me, checking on me, they're making sure I'm doing the training. I have to reapply for my practicing certificate every year. And if I don't do all the things they want me to do, then they just don't give it to me. It's as simple as that. And, clients have somewhere to go if they need extra support. So HMRC are looking to change that, which I think is really interesting. They're looking at, I was involved in the consultation on this a few months ago, the early consultation. They're broadly looking at two things: either forcing everybody who is working as an accountant to become a member of an accountancy body. That's what I think they should do. I think everybody should have to sit the exams and do all the hard work, just like I did, and that will bring all accountants up to the same standard. Or they're talking about perhaps creating a new government department or HMRC department and monitoring the unqualified there. I don't think they'll do that. It's going to be really expensive, but it's a consultation, and so they're having to look at all the. But that's something that's interesting to watch actually. The second thing that's buried in the budget, I think it's on page 26 or something, is making tax digital. Now, if you are a VAT registered business, you are already doing making tax digital. It's known as MTD for short. So what?
Just share the link, Emma, for people to have a look at after you've finished chatting. I pressed send a little bit early, so apologies.
Oh, right, for the next webinar. Brilliant. Yes. So yes, I'm doing a webinar on this in a month's time. So yeah, Making Tax Digital is HMRC has been rolling it out kind of section by section. So it's mainly affected those businesses who are VAT registered. So if you're VAT registered, you will know you have to be using MTD compliant software. A lot of you are on Xero, QuickBooks, Free Agent. And if I'm doing your VAT returns for you, or you're doing them yourself, you know that you have a direct link between your bookkeeping software and HMRC, and you submit those quarterly returns in the way that they need it to do. And it's about having a digital footprint. So it used to be that you could, like, to do your VAT returns, you could just like have all your paperwork on your desk, add them all up with a calculator and type the numbers into the HMRC portal, and the room for error there was astronomical, and the amount of tax they were losing was just ridiculous. So now, your bookkeeping has to be done on MTD compliant software, and it has to link directly to HMRC. So we've got that in place for VAT registered people. They're now bringing in the next section, which is people who are not. So it's sole traders and landlords, and they're bringing it in phases. So this was supposed to have happened, was it like this year or last year? It was either this year, I think it was this year it was supposed to come in, and they bounced it for a year because they didn't quite have the IT sorted HMRC side. But from April 26, if you're a sole trader or a landlord and your income, that's your sales income, is more than £50,000 per year, you will have to make a quarterly submission. And that's a lot. So at the moment, you're doing an annual tax return. You are going to have to submit once a quarter now. And that's huge. That is, a lot of sole traders are going to have to change the way that they work. We've been preparing this for a few years now. So I've got all of my sole traders, as you'll know, if you're one of my clients, you're either using bookkeeping software or you're using our MTD bookkeeping spreadsheet that I've designed, that we'll be able to use and do the submissions for you. But it's going to be, there's a lot of sole traders who wait till the end of the year and they go, all right, I better get all my records together. You're not going to be able to do that. You're going to have to do it every quarter and submit it. And it's going to have to be right. Then the following year, April 27, they'll capture more people. So that is sole traders and landlords with income over 30 grand. And then they've committed by the end of this parliament that it will be everybody over £20,000. So they're just pulling more people in every year. They've delayed the start date on this twice now. I don't think they're going to delay it again. I think they'll start to look stupid if they did. So I think, and April 26 is not far away. That's 18 months away. So I think, again, my really clear message to sole traders and landlords falling into this, that, talk to me about MTD, about spreadsheets, but I am doing the webinar next month, which will explain a lot of that in more detail, but it is in the budget is the important thing. So there's
a quick question, a couple of questions while we're on that subject. So just confirming, that's from April 2026, isn't it, for over 50k?
Yeah.
And is that, so Helen's asked, is this income tax self-assessment we're talking about, or VAT?
Oh, right, sorry. It's income tax. It is Making Tax Digital for income tax. So if you do a self-assessment tax return, VAT, you're already doing this. So if you are registered VAT, you are already doing this. You are submitting your quarterly VAT returns under MTD. This is for people who are for income tax, so sole traders. You could be a, I don't know, a mobile hairdresser or a plumber or, something like that. Or landlords. So you might have a rental property and it's that income over 50,000.
Thank you.
Yeah. It's massive. It's a huge, and it's sort of buried in the budget, and it's just not being talked about in the way that it should be, because it's massive. So yeah, it's a huge difference, and just the resource thing. I think there's a lot of people at the moment that DIY their self-assessments, and they sort of just about get by and submit it on the on the HMRC portal once a year, and it's sort of writing off. All of that's going to change. I think there's going to be a lot of people looking for an accountant who's going to have to take this on. There's going to be, I think it's going to be a massive change to the way this whole group of people work.
Thank you.
Okay. This is the last thing I want to talk about, and that's just because a lot of you know that we're part of the SEND community in my family. We've one of our children has Down syndrome, we have ADHD and autism within our family, and I'm very much live my life within the SEND community. And so most of you will know whenever I get the opportunity to raise a little bit of awareness, I do. So I have your ears for a couple of minutes, so I'm going to go ahead and do that. The first, so these are budget changes as well. So the first thing is the carers allowance. It comes in from April 25. So at the moment, you can receive carers allowance, which is very small. It's about 81 quid a week. But you're only allowed to earn up to 7,852 per year after tax and expenses. And if you earn even a pound over that, so if you earn £7,853, you are not entitled to the carers allowance. This is just this cliff edge. They're increasing that to just over 10 grand a year. So that's going to make a massive difference to those families. So if you are a carer, if you have carers in your family, if you know carers, make sure everybody knows this. It's really important. The other thing is, because of this cliff edge, so this at the moment it's £7,852. And if you accidentally go over by a pound or 5 quid or something, you're not entitled to the allowance at all. And if you've accidentally done that and continue to receive the allowance, you have to pay it all back. And these are low income families anyway. So they're going to review the overpayments and that cliff edge, which is wonderful. And again, I just really want to use my platform to spread the word. The second thing I'm really excited about is in the budget that they have committed to an extra 1 billion. That's a 6% increase to tackle the SEND in crisis. There is a national SEND crisis. This isn't talked about a lot, but there is. We got caught up in that as well. There are children with SEND in schools who are just struggling or not even in school, and they're putting some more money in it. I think the experts are going to tell us it's not enough and it's going to take a long time to fix, but it's a start. And the final thing I wanted to talk about was VAT on private schools, which seems weird that it might not fit in on here. And they're putting on VAT on independent schools, I think from January, which up until now, VAT on education was exempt. So, if you send your children to a lovely posh private school, you didn't have to pay VAT. Now you're going to have to. There is an impact here because there's a lot of children with special educational needs and disabilities who've been failed by the state provision. Their parents are selling their houses, borrowing money, putting themselves into debt to pay for their kids to go into private schools, and that those children are going to be affected as well. And that's a conversation isn't happening. So I think I'm just going to use my platform to make aware, if you've got these families in your life. So that's my little SEND piece that I always do. I think that that covers everything I wanted to talk in terms of the budget, and come fairly well in time actually. I was worried I was going to be massively over.
Emma, just a big thank you for making it so clear for everybody. We have taken obviously quite a few questions throughout the session. Um, and I think the message is clear. If anyone has any questions, to book some time with you. But if there's anything that anyone wanted to ask, we've got 5 minutes before the end of the session. We will close on 1:30 because respecting everybody's time. But if anyone's got a burning question that they want to share with everybody, please feel free to come off mute, or even just to have a little chat for 4 minutes now. I'm a stickler for my end times, I must admit.
Mhm.
It looks like silence is always the sign of a fantastic webinar. So thank you all for joining us. For those watching back, thank you for giving us your hour. Emma, thank you for your expertise and knowledge and clarity. And we shall see you all hopefully at the Making Tax Digital webinar on